Relative Strength Index, RSI. J. Wells Wilder introduced his Relative Strength Index in his 1978 book New Concepts in Technical Trading Systems. Wilder theorized that a rapidly rising price would eventually produce an overbought status, whilst a falling one could generate an oversold level. He also advised that under such circumstances price could retract sharply. Consequently, he designed his Relative Strength Index, RSI, to monitor the present and past strength of a currency pair by utilizing the closing prices of the recent trading periods. The RSI is a momentum oscillator which tracks the velocity and magnitude of directional price movements. The RSI calculates momentum as the ratio of the higher closes to lower ones. The RSI is normally operated using a 14-day time frame and produces readings on a scale between 0 and 100. Values of 70 plus are deemed to be overbought, whilst postings of 30 and below are considered oversold. Wilder advised that tops could be forming when the RSI registered values of 70 plus and bottoms when RSI readings fall below 30. You should also carefully note any divergence between the RSI and price, because such a feature can be an early warning that a retraction is imminent. For example, if you detect the RSI fails to achieve a new low whereas price does, then you should be aware of a possible bullish retraction. Wilder's research also suggested that support and resistance levels could be more easily identified using his RSI as opposed to the direct price chart. You should also note that an uptrend of a currency pair is normally traded between RSI values of 40 and 80, whereas downtrends usually registered RSI readings between 60 and 20. As such, when a retraction does occur, the new trend performs a range shift. You can also use the RSI to detect negative and positive reversals. They are formed during trends after rallies produce divergences between RSI and price. For example, a downtrend rally generates a lower high, but the RSI registers a higher one. Reversals help confirm the existence of trends because positive ones are only present during uptrends, whilst negative ones only exist in downtrends.